We do have some breaking news here. MSCI will increase the weight of China A shares in MSCI indices going from 5 to 20%. The index first added China just last year. It'll happen in 3 steps in May, August, and November. We were just discussing this huge run in Shanghai so far in 2019. Part of this in anticipation of this move by MSCI. Let's bring in Rebecca Patterson, the Chief Investment Officer at Bessemer Trust. Rebecca, great to have you with us. This will really change the face of the MSCI index by increasing this weight.
Absolutely. For the emerging market index under MSCI, China now becomes the elephant in the room. This was widely expected, so it's not a huge shock that it's happening. But as you said a few minutes ago, the passive flows into this are going to be a source of support for Chinese stocks for the at least months to come, maybe longer. And I think another really important point made earlier, if you have the combo of a dovish Fed, so stable dollar, so the renminbi can stay strong, and passive inflows into China, then as a foreign investor looking at China, I get a decent renminbi return and a decent stock return. It gives us legs for a little while, at least.
You sound like you like China.
Well, we are very overweight the U.S., but in December, we took our Europe underweight down even further and used that to add a little bit to emerging markets. We're almost neutral on emerging markets, and China obviously is a huge component of that. And we did that in part because we thought if we got a trade deal, which I think is highly likely, if we had somewhat dovish Fed for a piece of time, then we thought there was a valuation story and a catalyst there. But how long it runs from here, I don't know.
So you're more bullish EM overall, meaning
Yes.
China plus other markets, as
Correct.
opposed to just being a pure play China advocate.
Correct. And again, a lot of it is valuation. These currencies got destroyed over the last few years, and so they're going to benefit from a terms of trade shock that helps their economies, plus the equity valuation's much more attractive when we went back to December than Europe. So you had that, and then the trade deal, in my mind, was a pretty big catalyst.
So, Rebecca, when you look at the fundamentals, I get it on the trading aspect, and I get it on what's in and what's out on the China trade deal. But when you look at the fundamentals of investing in China right now, with debt to GDP, with the aging workforce, with productivity, what do you find? Is that forget all the other noise? Is that a buy or a sell?
Well, I think it's time frame, right? And I know a lot of the folks who watch this show are looking fairly short term. And short term, I think if you have China stocks, you hold them. But if you're looking out over the next year or further on China, you have to have a decent amount of skepticism, because if the U.S. slows next year, which I think it will, the fiscal stimulus wears off, Europe's a mess. It's not picking up anytime soon. China has a declining labor force, as you said. It needs Made in China 2025. It needs that productivity lift from technology. And if the U.S. is pushing back against that, how far are they able to take that to support growth? So the debt, I think they can massage for a very long time. But I think if growth slows, it puts everyone in a very nervous place around how long the Xi dynasty, if you will, can last. So I think it could make people anxious about how much exposure they have there. And God forbid, if the tech Cold War between the U.S. and China continues or accelerates despite the trade deal, and we push companies to work with allies rather than China to change supply chains, that's going to have a lot of ripple effects on China, on a lot of companies and sectors. That's not this week or this month. This is the next year, 2, 3, and it's something supported by both political parties.
Meantime, back here in the United States, you're using strength to trim.
Yeah.
Why?
So we actually went underweight equities about 2 weeks ago for the first time this cycle, very modestly underweight. We're not bearish equities, but we think after you have an 11% return in 5 weeks, most people would be happy to have that return for a calendar year. So I don't want to be greedy. If I think growth structurally is slowing in the global economy and I see some risks ahead, whether it's the aftermath of the trade deal, geopolitics, politics, policy, then I think if we have periods of strength, just to take a little off the table, I'm taking a medium-term view, trying to prepare my portfolios for the year or two ahead.
You mentioned Europe. So if the 18 or so EU nations were one country, there'd be 50 million more people, I think, than the United States, and a bigger GDP. And it's a mess, as you said. When does that affect us, if ever?
I think it's such a good point. If Europe were politically able to harmonize their bond markets into one bond market, it would be bigger than the U.S. Treasury market, and the euro could become the world's reserve currency. For better or worse, politically, it doesn't seem like that's ever going to happen, so it stays fragmented. But when you think about the 40% of S&P sales that come from overseas, the biggest chunk of that is Europe. So if Europe continues to have a hard time, or it slows further, or it hits a roadblock, it absolutely affects the U.S. If you only have a U.S. portfolio, U.S. stocks, U.S. bonds, you still have to care a lot about Europe.
Rebecca, great to see you. Thanks
Great
for
to be
coming
here.
back.
Thanks.
Rebecca Patterson of
Exciting day.
Bessemer. Yeah. Tim.
So a couple things. First of all, if you want to get EM right, you have to get China right. So if you're investing in emerging markets overall on the asset class, this is great news. And the weighting, as we talked about. We talked just about Europe. I'm of the view, just like China, we've priced Europe into going into a tailspin overnight. I have zero confidence in the European banking sector in the long run, but in the short run, Germany has printed a couple quarters of growth. It's a shock that came from the first quarter of last year. I would be getting long Europe here.
You know, it's interesting. About 10 minutes ago, we were talking about how the sentiment got overly bad in China in particular. And I think that just from that discussion, you got to think, well, if EM's going to come back here, then Europe's not going to be far behind it. And that could be a short-term 2019 trade. But I think the most important thing is that the S&P 500, the U.S. stocks, are the safest bet. It's just not where you're going to get the beta, in my opinion. And that's why you're seeing this outperformance, I think, in the things that might be bottoming where sentiment is really bad.